Now that even China's president has joined the verbal jawboning campaign to inspire confidence in retail investors and get them to buy Chinese stocks, vowing unwavering support for the country's private sector, just so Trump will finally stop pointing to the Shanghai Composites bear market as proof the U.S. president is winning the trade war, and following last Friday's dramatic plunge in Chinese A shares followed by a just as dramatic rebound on Monday, which however fizzled on Tuesday, analysts are finally taking a deep dive inside the risks and perils facing the Chinese stock market, and the biggest danger they find is a ticking 5 trillion pledged share time bomb. In a note released this morning by Goldman's King Lau, the China strategist looks at the recent rout and modest rebound in China, and compares this to the 2015 bubble and bust cycle. What he finds is good news, that the current episode is less systemic compared to 2015 because brokers' margin financing balance has been significantly reduced, from RMB 2.3 tn at the peak of June 2015, to around RMB 765 bn as of last Friday, representing only 1.8% of listed market cap, 3.8% of free float cap, off balance sheet. Hidden leverage is less prevalent based on our bottom-up aggregates and channel checks, and the overall leveraged positions in equities are significantly down from 2015. On the whole, retail investors' exposures to equities remains low in terms of their asset allocation, with equities accounting for roughly 3% of Chinese households' balance sheets, versus 63% for real estate. But in a key shift, users of financial leverage in equities have shifted from individuals to major shareholders in the form of stock-pledged loans, SPL, this time around, with the risks revolving around SPLs being the major concerns in this market downturn. And yet is this massive stock-pledged overhang, which precipitated a huge margin call last week, and which we first noted almost half a year ago, quite as benign as Goldman would like to make it? Here are the facts. By aggregating more than 40,000 transactions from Wind, around 5 trillion yuan worth of A shares have been collateralized for financing, 11% of listed market cap, with 3,478 A share companies engaging in SPLs, 98% of total listed companies. That said, 5 trillion Chinese yuan represents the aggregate notional value of the collateral, as brokers and banks usually provide 35 to 40% loan-to-value (LTV) for stock-pledged loans, implying around 2 trillion yuan of outstanding SPLs based on a 40% LTV assumption. Given the weak market performance YTD, Goldman then estimate that around 1 trillion yuan of SPLs are at margin call liquidation risk, representing 49% of total loans outstanding, 2% of market cap, with the potential loss on SPLs accounting for 2% of aggregate brokers' capital. And while the above risks look largely manageable according to Lau, the threat is that the self-reinforcing nature of SPLs, which applies to all kinds of financial leverage, makes this a dynamic risk factor. In this vein, one can assume that if the market falls another 10%, 30% from here, largely matching Goldman's bear and crisis scenarios, 1.2 trillion and 1.7 trillion yuan of the outstanding SPLs would be facing margin call liquidation risks. And here Goldman makes a bold assumption, namely that whereas historical data on actual defaults, liquidation is sparse, the bank believes that most borrowers facing margin call pressures were able to come up with more collateral, i.e. cash, equity, or even properties, to top up margin. Even for those who couldn't secure additional collateral and stock prices fell below liquidation levels, forced selling by brokers has seldom happened, because there are many restrictions on major shareholders disposing shares in China. Brokers tended not to liquidate the positions, as doing so would trigger more selling pressure and deplete the value of other collateralized shares. Brokers don't want to damage the relationship with their corporate clients, and, in some cases, regulators gave window guidance to brokers to avoid forced selling. The above four may well be accurate, and yet the question then emerges, why did precisely the kind of market-wide margin call and subsequent liquidation take place last Thursday, when it was, according to Goldman, not supposed to? Would it, perhaps, indicate that borrowers have run out of more collateral to pledge? And if so, just how long until the next major market sell-off triggers the remainder of China's ticking 5 trillion yuan pledged stock time bomb?